We believe there's a number of catalysts for Japan. If you talk about, like you said, M&A, where are these companies looking to do this? Well, one, they know they need to be more shareholder friendly. They know they need to reduce a lot of the cross holdings that a lot of Japanese companies have with other big names within the exchange. The Tokyo Exchange has motivated the companies to look to bring value to their investors. And we're seeing them sell down names within the exchange and use that money to invest. They are sitting on strong performance. They're sitting on a currency that is slightly stronger, and we believe will stabilize around this level of 140 for some time. They're in an environment where they're seeing healthy inflation, and the economy is doing pretty well. And Japan, as you said, is back in the spotlight. We are having so many inquiries about Japan every day, and I think corporates get in the same thing, same interest. So when you have the sun shining on, you look to make hay. We believe the Japanese corporates will continue to do this, and there's still a lot of upside to come in this market. And this is excluding all the local buying. You know, the Japanese investment accounts are opening at an incredible pace. You're seeing that $7 trillion worth of yen starting to move into the market. You're seeing share buybacks from companies. There's a number of different factors that are supporting this Japanese equity story.
Gareth, there's always a what if, isn't there? And what if payrolls disappoint? What if we see a material degradation in the labour market and dollar weakens materially, yen goes for another ride north, and then of course there's the BOJ. Are they going to look at this environment and think, well, we're going to have to sit on our hands at this meeting?
Yeah, as you said, there's always a what if. So we normally try to break it down, all the different components, and see how likely. So yes, there could be a payroll shock. That would mean a jumbo rate cut. That would mean the interest rate differential between the US and Japan will diminish even more. That would indicate a stronger yen, and it might push out. It's likely then a lot of the work has been done, and the BOJ can sit back and watch a bit. At the same time, we don't think the Japanese equity story is all about the currency anymore. After COVID, a lot of the manufacturing in Japan actually moved offshore. So a lot of the sensitivity of sectors within Japan to the currency is diminished. And if anything, a lot of the manufacturing are reliant on commodities to be able to build these products. And a stronger currency helps them bring those commodities in at a better level. This is one of the concerns that a weaker currency had when we were talking to CEOs at corporates, was that buying materials to build these products is very expensive with a very weak yen. That has changed. And we do think that, if we have a shock in payrolls and a move in the yen, it's still unlikely to be a major driver of direction for Japanese equities.